All right. Welcome to another episode of Millennial Money Matters with Kelly Turner.
And Derek Mazzarella.
Hey, Derek. It's been a while since we've recorded an episode.
It has. Yeah, I missed you.
Yeah, well, it's May-cember, which if you're a parent, you know that May is worse than any other month of the year for us because it is the month where the weather finally gets nice. You are expected to take care of your house, your garden, your landscaping. Your kid has 9,000 baseball and softball games and practices. They all get rained out and then rescheduled on other days. And you need to be at school for your children in the middle of the day 37 times.
Oh, yeah. Just because we got to celebrate every little thing about them. Hey, you're moving up from grade 1 to grade 2, or you're, whatever.
It's field day.
Yeah.
It's writer's workshop day. There's a jump team performance. I'm going to the Yard Goats tonight to watch my daughter jump rope on the field with the jump team. So it's a little crazy right now.
I didn't realize that a jump rope team was a thing.
Oh, it is a thing. I didn't either until my kid was on it.
I feel like I'm having, withdrawals from not being able to do that as a kid.
Listen, these kids, they live a different life than we lived.
They do.
They do.
Can I tell you about my morning meltdown?
I would love it.
My
Will it make me feel better about my own children?
Yeah. So for all the parents out here, you're probably gonna be nodding ahead. But so my son, I'm like, what do you want for breakfast? He's like, I don't know, and he gets very aggro and very angry right away. So I was like, all right, buddy, you already had a couple waffles this week. Let's not do waffles. And he was like, I want a waffle. And I gave him 100 million other options. I was like, bud, if you can make it yourself, go for it. So he gets his little stool, like moves over to our cabinet there and tries to get, usually puts peanut butter on it. So he pulls one jar of peanut butter. There's not enough peanut butter in that one. It was 3/4 full.
Oh man.
He wants the other one that is not opened yet. And he's screaming at me that he wants that one. He's throwing things. He threw his little stool over. He threw trail mix at me. So
you're like, hey, happy Friday morning.
Yeah. I'm like, how are you this angry this early on a Friday?
So what was the result? Did he eat his peanut butter?
Yeah. Eventually he calmed down and got his own peanut butter and globbed it on there himself. Yeah, but he did. It took like 20 minutes of screaming though.
And you said, live your best life with your peanut butter.
I was like, I'm going to go over here.
Yeah.
I need a minute. You go do your thing.
So your next life is I have taught my 7-year-old how to make scrambled eggs himself. And it has alleviated all of my breakfast arguments because he wants to eat them and he wants to make them. So I'm like, bro, go make it. And he puts his butter in his pan and scrambles his egg.
That's impressive.
And he, is then happy to eat it, and I don't have to have the breakfast fight with him.
You don't have trail mix throwing in your face? Or?
No.
Okay.
My middle child did cry about breakfast this morning, too, though. So, like, you're never free from that.
I'm always like, how are you this mad this early?
This early, yeah.
It's like you just woke up, and you're like, I hate this.
I hate this so much. Yeah. Well, there's a lot of things we hate, Derek.
Yeah. So we've got the most soundproof investment concept known to man. You want to talk about it today?
I do. I'm here for this.
All right, let's hear the sales pitch. Imagine, I'm going to use my sales pitch voice.
I love it. Do it.
Imagine if you could take control of your financial future, never rely on a traditional bank or loan again, and have your money working for you uninterrupted every single day. That's the power of infinite banking.
I can't even take that seriously. I
Yeah.
can't. Okay.
So the question is, what is infinite banking?
Okay, so I have heard the term before on the Tiki-Takis.
You may have heard be your own bank.
Be your
as
own
well.
bank on the Tiki-Takis. But I don't even know what it means. Like, I don't know. Is it like you just put your own money in the bank and you borrow it? Like, what does that even mean?
Well, you put money in this magical investment vehicle where it grows, and then you could take out as much as you want. You can borrow against it. You can blah, blah, blah. You can it adds interest when it's in there. So it's really just like this magical unicorn investment, and I feel like everyone should be doing it.
Okay, what's the catch?
Okay.
Because there's obviously a catch here.
Yeah, so this is a little extreme, right? So I feel like it drives me nuts as a financial advisor to see this advice all the time, especially when it comes to like the average income person. Like to me, this is like a rich person's thing, and they take this rich person's thing and try to apply it to every single person.
That sounds like a lot of the investment strategies we've talked about on the show. This is like the house hack, buy all your multifamily houses. This is, the last episode was like buy all the Airbnbs, but people don't realize how much work it is.
Yeah.
I feel like that's a theme here that like there's no get rich quick scheme that actually really works.
No, there's not. Not at all. So basically this concept is you use a life insurance policy.
We're talking about life insurance here?
Yeah.
This is life insurance?
Yeah. So it sounds like it's really cool and sexy, but
Yeah.
it's just life insurance.
Like grandpa old life insurance.
Yeah. Like since like the 1700s, we're like at our pickaxe for gold, and we got a life insurance policy. We're good to go.
Wow, I did not know.
Yeah, and basically the concept is because there's basically two types of insurance. There's term insurance and I'll do a quick aside, is you're basically like renting a policy. So you have let's say a 20-year term policy. You're buying $500,000 of coverage for 20 years. At the end of 20 years, hopefully you're still alive.
Hopefully. If
no
not,
more.
you got your money.
Someone's got your money. You don't have your
You
money.
don't have your money. You're right. If
super
you
dead.
got, somebody's got your money.
If not, then
You got to start over.
Yep, start over again and buy it, and now you're 20 years older, right?
Okay.
So you're just totally renting it. A permanent policy, you're putting money in. The difference is the insurance company is going to basically pay out a death benefit at some point, but along the way, it builds up what's called cash value. So it does have an investment component to it. So it's not like nothing happens. It does exist. The challenge is there's multiple types of permanent policies. They all work a little differently. I don't know if it's worth quickly going into those.
Do it. Because
Okay.
life insurance for me is that thing that nobody wants to talk about because you don't benefit until you dead, and you don't want to talk about the people you love dying. So you sort of should have it, but it feels ugly, but then it also feels like a scam at the same time.
Yeah. Well, I think the other thing is, I don't want to jinx myself. I always hear that. It's like, well, just because you sign up for it doesn't mean you're going to die.
Yeah. Well, but you are going to die. That's like the reality of this, people, is you are in fact going to die. We hope it would be later.
Hopefully.
But it's going to happen at some point.
Right. So there's basically three main types of permanent, right? So the boring one is called whole life insurance. You want to think of this as like the bond one. It just earns a very consistent rate of return. Usually it's like 2 to 3% per year. It just chugs along, and they basically, the insurance company is basically paying you dividends. So they're giving money back from what the investments that they made on you, kind of like how a bank gives you interest.
Okay.
It's the same kind of thing. The other side of the extreme is a variable permanent policy, right? So the way that works is they're going to invest in stocks or mutual funds within your life insurance policy. So 1 year you could be up 20%, 1 year you could be down 20%. So there's a lot more variability with those variable universal life policies are called. And then in between is called an indexed universal. The difference there is usually you can't lose money on it because they have a floor of 0. So let's say the market goes down 30% in 1 year, you just don't lose money.
You're just you're
like,
right
cool.
where you started.
Yep.
Yeah.
But it also has a cap, so it's a downside. They're not going to give you all the upside and another downside, right? No one does that. If they did, that'd be great, and I'd definitely buy that policy.
That would be the smart policy.
Yeah, but the caps are usually much lower than what you could get in the S&P, for example. So let's say the S&P goes up 25% in 1 year, your cap may be 8. So
Way lower.
Instead of getting 25%, you're getting 8 that year.
But if it goes down 30%, you're fine.
You're fine. Yeah. So some ways it can even out. The other thing to consider is because they buy options, you don't have to know any of this part of it, but they don't
gibberish.
they don't pay you dividends. So you only get the price return of the
Okay.
S&P. So like some companies like Verizon will pay you a dividend each year. Like that's included in the S&P, which is usually about 2% of returns per year on average. So you have a little less actual return to keep in mind.
Have my eyes glazed over yet?
She did. Yeah, they did.
They glazed over. Okay, cool.
So just a little wonky thing to know, and this is probably going to come in later. So just wanted to.
Yeah, well, and again, I think this is like super valid because people fall for this sort of hype stuff because of the eyes glazing over part, right? That like the technicalities of these sort of things, you're like, I don't really care. But when you tell me infinite bank policy, that sounds really exciting, and my eyes are no longer glazed over.
Well, I'll just give you. Let's say the cap is 10, right, for easy math, and then the S&P does 10 that year, but 2% of that is the dividends. So you're really going to get 8 in your contract.
Yeah, because the two
is dividends.
and stayed with the life insurance company because they're like, this is our cut here.
Sort of, but yeah, that's fair enough. So those are the kind of the 3 types of policies. Now the infinite banking folks go with either the whole life or the IUL.
Okay.
Because the investment stuff is too risky for them.
Because they got to borrow this money.
Yeah.
Because it's a bank.
So here's kind of like what have you ever heard the term? It's a Swiss Army investment.
Yeah, and that is, again, I think when I hear that, my eyes glaze over. That's a glaze over moment for me where I'm like, okay, but isn't that all investments? That they're all sort of, I don't know. Please explain. What does the Swiss Army investment mean?
Well, because they're saying, okay, look, so you're getting a death benefit, so that's one benefit for it, right? It'll build cash value, so it has an investment component to it, so that's another one. It has tax deferred growth. So while the cash value is building up, you pay no taxes on it.
That sounds kind of good.
So that doesn't suck. You could take a loan against it and have tax-free income out of it.
Also sounds kind of good.
So it can do a couple things, and there's certain riders. So if you get disabled, it'll actually pay the policy for it. Some have long-term care components to it, where you can borrow a percentage of the death benefit to pay for a long-term care expense. So it has all these features. The challenge is it can't do all of them at the same time.
Oh, okay. So yes, these are valid. Yes, they can be great. But where, again, the infinite banking people go wrong is that, like, it can only be doing one of its jobs. It can't be doing all of its jobs at the same time.
Yeah. So if I'm talking to a client about life insurance, we get to like, what is the goal of this? Is the goal of this to have the death benefit for estate taxes or something like that? Or is the goal to really build it up and use it as an investment vehicle? Because if that's the case, then the death benefit should be kind of pushed aside.
That's not what we're worried about.
And yeah, but they're kind of telling you, okay, it has all this cool stuff, blah, 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 blah. Because I mean, I'll give you an example. So if you take a loan out and you never pay it back, let's say your death benefit's $500,000, you take out $100,000, and you owe $100,000 when you die, your beneficiaries get $400,000. So they don't get that plus.
Yeah, the loan is a real loan.
It's a loan. It needs to be paid back at some point.
So where is this sort of hype about infinite banking coming from? Like, is this overzealous salespeople who
Yes.
want their commission and
Yeah.
they're trying to, ooh, this thing is sexy? Are they just trying to sexify something that's been around forever to sell more of it? Because I do think one of the millennial like traits is that we both want to make money because money's have been a struggle. We've covered that in other episodes. We've lived in a money scarce time that feels like we both have a lot of money and no money. So we're always looking for ways to make money. But we're also very skeptical of old fashioned ways of making money because they feel irrelevant to us. So are we just taking something that's been around forever and trying to hype it up for the younger generation?
Well, this concept has been around for a while. So infinite banking, I think, was invented like the late 70s, early 80s, if I remember correctly. But basically the concept is you put money in this policy, it builds up cash value. And at some point you can say, hey, look, I want to buy a house, whether it's a rental property or maybe it's your primary residence or you want to use it for something. You borrow against the policy because I'll give you an example. Like, in 2008, credit went away, right?
Yep,
it was really
very hard to
credit,
get a
right?
loan.
But you said all these houses are on sale. I've got this asset over here I can borrow against. And then I can buy a couple houses, and I don't need to get a loan. I don't need to have any.
Well, I don't need to get a loan
from a
from
bank,
someone else.
From someone else. So I don't need to get. I'm not dealing with their liquidity issues. I'm not. Like you are your own bank, so you have your own power to say, look, I'm going to go put a down payment on this house.
Yeah, you're not getting qualified. You're not dealing with someone like me, or you want it. Here you go.
And your policy is already the collateral, so you don't have to put up additional collateral. Like let's say you want to buy a house, you already own one. Oh, you're not putting up your own house. You're putting up your policy essentially. So there is a use case for it. But I think where I see it goes awry is like, oh, you borrow against it, put it back in there. You borrow against it and put it back in there. And like, you can keep borrowing and pay. Like I paid off $120,000 of credit card debt by doing this, which is just total BS.
Yeah. Well, you're using an asset to pay for a liability. Like,
yeah, but the problem is, you have to put the money back in there to keep it growing. Cause I guess it's probably important to know kind of how mechanically these policies work. And a lot of people are probably like that are life insurance people that are like listening, screaming at me right now. You got to fund it properly and all that stuff. So let's maybe take a second to talk what that's about. So, all insurance has a cost. So I looked up just for my 39-year-old self, and here's a quick tip for everyone. If you're within 6 months of your birthday, they treat you as the next birthday. So I'm 39 right now, but I'll be 40 in July.
So you are 40.
So I am 40.
Oh, I love
If
that.
you're looking at buying a policy, this is like when you're like 5, you're like, I'm 5.5. Like this is where the actual half kind of comes into play again when you're an adult for the only other time. But like I can get myself a 30-year term policy for $500,000 for $540 a year.
That's the rented policy.
The rented one, right? So
that's pretty cheap.
Pretty cheap, right? The index universal one is about $7,179
a year.
A year.
So they're not
7,000.
cheap.
So yeah, a lot more expensive. A whole life one is $8,945 a year.
Okay. So not crazy more than option
no,
2.
but the point of that is you're buying insurance, so you still have to pay for the insurance part of it. It's still going to build up cash, and where the infinite banking concept comes in is like you have the thing with life insurance. We could actually overpay for something. So instead of putting like $8,000 in or $9,000 in for the policy, you'd be putting in like $18,000 or $25,000. So it's some insurance. And the way that you design this is to minimize the death benefit and maximize the cash value.
So can we just pause for a minute so I can ask this question?
Yeah.
Like, this is still your money that you're putting in. So like the difference between using a bank and using this is when you use a bank, it's not your money, right? It's not your money. It's somebody else's money. So you're leveraging somebody else's money. When you're doing this, it's your money, which also means you're not putting it somewhere else.
Right.
You're not.
There's an opportunity cost to this.
Yeah, it's not in your retirement account. It's not in an investment account where it could be making 20%. It's not in
your home even.
In your home, in real estate investments. Like it's just your money that's chilling for you to borrow it again.
Right, basically. And so I was looking around to kind of research like why are people doing this and like what are they selling. So I actually did find, when you do an insurance policy, you get what's called an illustration. It shows you all these ridiculous columns that you probably can never read.
It's like an amortization schedule for a mortgage.
Yeah, you're just like, that's a lot of numbers,
yeah.
right? So so they're using a 31-year-old in this example here that I have. So obviously health is a factor. So if you're have cancer or you're like a chain-smoking overweight diabetic, you're probably not going to get this policy.
Well, and this is just a quick pause. For those of you who have life insurance or don't have life insurance, when you get life insurance through your work, generally it's just auto-assigned to you. You don't have to do anything.
Yeah.
If you are getting life insurance with an outside policy, you are usually having a physical. Mm-hmm. You are giving a medical history. You may be giving medical documentation from your doctors. You're giving permission for them to speak to your doctors. So like, if you have made it to 40 and do not have any medical problems, God bless you. Enjoy, have a great time. But most of us have something, and that can greatly impact what these policies cost.
Right.
Like, so full stop. Just know that like, this is what you want to do when you're younger. But like, I got life insurance, I don't know, 2 years ago, and I was astounded by the work that it took to make that happen. And like, they don't just want to talk to your primary care. I had to give them all of my doctors.
Oh yeah.
If
they
needed.
Mental health's a big thing now. All that
Everybody,
stuff,
yeah. my OBGYN, and they pulled like birth records of my kids and like, have you had your mammogram? And like, they want everything because they're betting on how long you're going to live.
Right.
And like, people have to get that part of it. Like,
yeah,
it's invasive.
Yeah. They price that in. All right. So anyway, so this example they use, this person's like, oh, this is the best way to go. So the base premium is $3,500. Okay. They're putting an additional $28,000 in and change, right? So their total amount they're putting in is $25,000 a year into this policy.
A year.
Every single year. So that's the other thing you got to think about. Like, you're funding this every year. There's no like, if you're borrowing from it, you're paying yourself interest, but also you have to pay premiums too on top of paying back the interest. So I know you're paying yourself the interest, but
but you
it's
still
like a
gotta
mortgage,
keep
right? You
going.
can't just say like, hey, I'm taking a home equity line out of my mortgage. I'm going to stop making the mortgage payments. You're still making the mortgage payments.
Gotcha.
So think of it that way with the life insurance policy. You're still making the premium payments. So they're overfunding it by a really large amount. So after 5 years, you put $125,000 in this policy. What do you think the policy is actually worth right now, the cash value?
Well,
based on this illustration.
If this is a good investment, more than $125,000.
It is at $120,184, and that's the non-guaranteed amount.
So how many years did you say this is over?
5 years.
So I want everybody to contemplate that too. If you put $125,000 in 5 years into an investment account, it would be worth more.
Hopefully. Yeah.
Like,
yeah.
Pretty much, it would be worth more.
Yeah. I'd say if you invest it correctly, it should be worth more than that.
Okay, just for clarity. Just want to make sure that I'm understanding this.
So then after 10 years, we're at $250,000. Okay, now we're at $288,000 of cash value. So,
okay, so I made a little money there.
So you made, $38,000 right after a couple of years. And they're going to show you, hey, look, well, after, year 4, you put $25,000 in, you're getting $26,000 increase in your cash value. So like, we're already like up there. Like, yeah. So generally you're paying for the insurance the first few years, and then you're kind of catching up after that. But you have to commit to this for a long time. And a lot of things that I have a problem with is like, oh, it's liquid. It's not liquid because you're not getting your money back right away. I mean, yeah, so after 1 year you put $25,000 in, and this one you have $19,000 of cash available. Like, that doesn't sound great.
No.
And you're not going to borrow, you're not going to pay anything meaningfully with that.
No.
Anyway, you may as well just use the cash at that point.
Well, that's it. You put $25,000 in to borrow $19,000 back. Like,
well, you can't even always borrow the whole amount either. So you have to keep some cash in there to keep the policy afloat.
This is not sounding great to me as this strategy. Again, life insurance, valid, real, people need it. But this particular strategy, I can see like where this can go south.
Right. And one of the arguments they're going to make, and it's going to be similar to a home equity line of credit, is, okay, let's say I've got $100,000 of cash value built up. I take out $50,000. I'm going to get a loan payment or interest payment on the $5,000, right? So I have to borrow $50,000. I'm going to have an interest payment on the $50,000 of, let's say, 5 or 7%. But I'm still earning the same interest on the whole $100,000. So it's like, oh, there's some arbitrage there, right? Like, I haven't taken 50,000. Like if you took 50,000 out of your bank, you're not earning.
No, you're
50
earning zero. You're earning $0 even when it's in your bank, but you're earning.
Well, no, but if you had 100,000
nothing.
in the bank, you take half out, you're only earning interest on the
Yeah.
remaining amount, right? So they're saying, well, you still have the whole 100,000 in there that you're earning interest on. But yeah, you're paying, interest rate on the money you borrowed. So you're not exactly getting. It's not a 1-for-1.
Not a 1-for-1.
Exactly. So you may be earning 4, but the interest rate's 6.
I will say the other piece to this is that I'm a belief in like keep it simple when we're talking about this stuff, and this just feels so complicated, so convoluted and complicated.
It is, because I don't think people why would you understand how this goes unless you do this? Like,
Correct.
There's a lot of moving parts.
But people are making this decision from watching like YouTube videos.
Right. Or they're just talking to someone who's like, oh no, we overfunded, boom, 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 boom.
Everything's great.
And then, yeah, we're all good in the hood here. But that's the challenge is it just doesn't work the way they're telling you it does work. In order for this to really work, you have to overfund the crap out of it. As you see, your base premium is $3,500. You're putting an extra $20,000 in.
Yeah, right. 20,000. Like we're not talking about a little bit of money.
No, and if you did, let's say you just doubled it, it's not going to get you there, right? 2, you have to commit to it for a long time. Like it's not we're going to do this for 3 years and I'm going to have all this money to invest all these properties and I'm just going to build this wealth and do all this fun stuff and magical fairies going to come down from heaven. It's not going to happen, right? So you just need to have this policy really designed well for you. I talked to someone who was really smart about this stuff and I was like, well, what's the real value of it? And one of the things he said to me that I was like, instead of actually borrowing it from your policy directly, you can actually use it as an asset to leverage it from and borrow from a bank. And that could be, you might be able to use that earlier than you would normally just borrowing from the policy itself. But then you have to deal with the underwriting and all the other stuff that we talked about that's a negative.
We're not a negative, Derek. The bank is a delight.
Yeah, I love going to banks.
Everybody loves us.
So, I mean, that's the real challenge with this strategy in general is that there's a lot of moving parts to it. It's really expensive. You need a lot of dough to make this work. So the rank and file person that makes $60,000 a year.
This isn't it.
You're not putting $30,000. You're not putting half your salary in here.
No, this isn't it. Now, I think the other piece too to recognize is I also think it's a bit of a psychological trap in that this is still a loan. When you are borrowing this money, it is still a loan. It's a loan from yourself, and I totally get that. But there's a negative if you don't repay it.
Right. Yeah. I mean, eventually because the problem is the loan actually will build up if you don't pay it off. And then it eats away either the cash value or your ability to get dividends. It can ruin your death benefit. And if it gets to a certain point where you don't do it, the policy can actually collapse, especially if you have, let's say, like 2000 and 2002, where you had multiple negative years of the stock market.
Oh.
So if you're earning 0, 0, 0s, yeah, you're not losing money, but there's fees to these policies. So fees are usually like 0.5% to 1% a year on the policies. There's annual fees of like $35 to $75. So it's going to slowly erode anyway if you're not even earning enough. So that's another challenge you can have.
Well, and I think the collapse piece too, if we go back to your Swiss Army knife, the other collapsible part is, right, you have these intentions for this. You start borrowing against it, taking loans, then you get sick, then you have no money left in the policy, but now you can't get a new policy to help your family if something was to happen to you because now you're old and sick,
right,
and you've taken all the money out of it, and now the main purpose of the policy no longer exists. The benefit isn't there anymore.
Right.
So that's the real collapse fear for me, is that you've been sold this thing that's supposed to solve all these problems, but it's a solution, or it's a solution in search of a problem.
Yeah,
It cannot do all the things.
No, this is like a rich person's thing. Like if you're already stuffing your 401k and you already have a bunch saved in your investment account, you already maxed out all your Roth accounts, you're looking for some other way to have some tax efficient growth and things like that. This could be an option for you. But like I said, you need a lot of money to keep feeding this thing, because if you don't, it can collapse on itself. And the other thing is there are other alternatives to kind of quote unquote be your own bank. Like we mentioned your house, right? You can take money out of a home equity line of credit. Like I use that to get my property here in Connecticut.
Yeah, and that's a super, in mortgage world, super common all the time.
Yeah.
People do that all the time. It is very smart. And I also like it because it's two like investments, and so the risk is usually similar.
Yeah.
I always get nervous when people are mucking in one investment, which has one level of risk, to purchase or add to another investment, which has a very different level of risk. And that, I just don't think people always contemplate what that means for them.
Yeah, that's a great point too. And and speaking of the risk part of it, in order for you to basically return from an IUL policy, what you would with like the S&P 500, for example, you probably need a cap rate of like 12 to 15 to 17, depending on what time frame you're looking at. And they're at like 8 or 9 right now. So they're well below that. So you're pretty much guaranteeing that you're going to, I don't say guarantee, but you're probably most likely going to underperform the S&P there anyway. Because the other thing you could do is they have what's called securities-based lending. I don't know if you've ever heard of this.
No.
This is what also a lot of rich folks do. Like, if they got all this company stock, you can actually borrow against your equity position. So you have, let's say, $200,000 in equities or investments in the S&P or company stock. You can usually borrow up to about half of that. Same concept. The money's still invested, so still going to grow, and the market could go up 20%, and now that growth is 20%. I mean, it could go down the other way too, so there's margin calls. There's definitely some options for that to definitely go awry. But that's also another option where you say, hey, look, I've got this investment account. I don't, if something really happens, I've got an option, or you can still borrow against it. So there's not like only one alternative to quote unquote be your own bank. You've got your 401k you could borrow against, and you have your home properties that you can always borrow against.
Now, all of these concepts live because they do work for someone. Is there anyone other than rich people that this may be a sound way to invest or way to be your own bank? Or is it at its core still kind of, I don't want to say like shammy, because again, life insurance isn't a sham. It's real. You need it. Using it in this way or thinking about it in this way is where it becomes
I think if you're too aggressive with it, I think that's the problem. I think if it's kind of like the example I used earlier, where it's like, hey, I've been putting a little extra in my life insurance policy because I want to build up the cash value, and I just want to be ready in case something happens, and there's an opportunity. Like, to me, that's where it's good, and you have the ability to kind of pay that loan fairly quickly. Like, that's when it can work pretty well, and that can be something for an average person where they're just putting like 10 grand in a year. And, it's built up over time. And, hey, 10 years from now line, like, hey, we want to get a vacation home and something just went on sale because, a hurricane hit the area, whatever. Right. So they can jump in and do that pretty quickly. The other thing I kind of had talked about in my book a little bit was it's, if you do a whole life policy, it's a non-correlated asset, which means that it's not tied to what the market does. So if the market's going crazy, like drops 50% like it did in 2008, it's going to keep chugging along. You can actually use that as a leverage point and borrow against that for a year or two, let your investment accounts recover for a couple of years, and then kind of refund the account back that way. So you can use it in different ways, but I think you really need to have a plan for the life insurance policy before you get into it, because you want to know, like, am I building up the cash value or am I using this for the death benefit? Because that's your first decision point with these policies.
It's one or the other.
Yeah.
Really, it's one or the other.
Yeah, because if you're doing one, you're taking away from the other, basically.
And I think the other message that I'm getting here, because again, I have seen some of these videos, and I, like most of us, get sucked into the YouTube trap sometimes, where you can learn so many things on YouTube, and so many of those things are not true.
Yeah.
Or they're just overblown or overhyped. Is that this sounds like a concept that has some merit.
Yeah.
Does have some value for very niche, specific people in specific circumstances, but it is being sold on the internet as an amazing solution for all, that everybody should be doing this. And people get really sucked into that sort of narrative that, like, I'm missing out if I'm not doing this thing, or this is the path to the wealth. And I think, and we've talked about this on other episodes, that is like just a true like millennial vibe, that we want the path to the wealth because it's been hard for us, and we feel like our parents and the boomers got something easier than us, and so we're always looking for, like, man, how do we get that too? How do we get that too? And like, this just doesn't sound like it.
And I think it also falls in the trap of like following that rich person that or rich uncle, like, oh, this is what they did, so I should do that too. It's like they can have totally different situation where they can afford to do something like this that you cannot. It doesn't make sense for you to do, but it makes sense for them to do. So you really need to look at like the personal part of like personal financial planning.
That's a good concept too. And I think that is something that, right, when you see what somebody who's really wealthy is doing, you want to emulate them, but their wealth has afforded them opportunities that your financial position hasn't. Right. So like, you don't know all the some of what they may be doing with their investments is tax harvesting. Some of what they may be doing with their investments is purposeful tax loss.
Right.
Like they're depleting assets. They're doing things which don't make sense here for you, but make sense for them, like way out somewhere else in an asset that you don't own, in something that you don't have. So I think that's really valid for people, is that just because someone rich is doing it doesn't necessarily mean it's the vibe for you.
Right. Exactly. So hopefully that gave a not so boring life insurance, be your own bank.
I glazed a little bit, Derek. I glazed a little bit, but you caught me back at the end. I appreciated that. I think Well, and I think that's what I love about these sort of conversations that we're having is that, again, as a financial professional, a lot of these concepts are still foreign and they're sold to you in so many different ways, under so many different names, under so many different concepts that it's hard to figure out reality sometimes.
Yeah, and I think this is where we're talking to like a professional, someone that's agnostic. Like, don't talk to the life insurance salesperson who's like, they need this commission to do this policy, because that's basically a part of this, right? So like, find someone that's agnostic that can give you good, solid advice. That's not there to just sell you a policy, to give you the real skinny on like how this could or could not fit in your life.
I like it. I'm here for that. All right. Well, this was super informative. I don't feel like I need a nap after, where like some of these I'm like, whew, has a lot of information.
You're not going to throw any trail mix at me?
I'm not going to throw trail mix at you. I may go eat some peanut butter though, because that sounds delicious. And then hopefully you will all join us for our next episode.
Yeah. See you soon.